Hi, welcome to the Market Alert for Wednesday, the 1st of April 2020. So stocks suffer worst start to a year ever. I'm not surprised, down 30% as Trump approval reaches record high. Not so sure about that, but I'm not into politics anyway. More interested in the economy and what's going to happen going forward. And going forward, let's start off with the daily chart of the Dow. We can see that the market has done its 50% retracement and failed to close above the 20-bar moving average, closed below the 5-bar moving average and is heading south. And that is of great interest to me because if we, I'm just going to check something first, just 1 second. Yeah, that's what I was after. Right, yeah, so what we're looking at here is how far the market's going to come back down. Well, I can tell you straight off it's going to take out this low as we go through April. And the reason for that is very simple. The economic data that's going to be pouring out over the next month is going to be nothing short of catastrophic. And how a market can actually move higher on that basis is absolutely bob open and no sodding hope of moving higher. So we saw last week the unemployment figures 3.28 million. This is not going to get any better. The figures are out again tomorrow. We've got the Fed's updated balance sheet also out by the end of the week, of which I'll keep you posted. So here are your markers in the sand of where the market is likely to move down to. And then, of course, we've got this low here at 18,167. That's the low. And for me, that's the start of the next leg down once we start to break this. The short side has failed to move higher. And like I say, some nice simple logic here. No break above or close above the 20-bar moving average. Back below the 5-bar moving average. It's a great average to use, as you can see. As we come down here, and this is the first one that breaks on the upside. The market stays above the 5-bar moving average until here, and the 20-bar moving average as well. 50% retracement is about as classic as it gets, and then we've got the downside there. They printed 2.2 trillion last week. Well, actually, they've not printed it yet. They passed it, but they haven't sent the checks out yet with the helicopter money. And already the Munchkin, Steve Mnuchin, is already going back to Congress. And also Trump is speaking to Pelosi to look at a second tranche of 2 trillion. I mean, you can't make this stuff up. They're printing confetti like it's gone out of fashion. But then why am I surprised? Well, actually, I'm not, because this is how the end game actually unfolds. And this is what they're going to continue to do. So that's the bigger picture. Here's the overnight. You can see the market's already on the down scale here, working its way down. We've got 100, 200 points down already off this short move from the open. We just move over to here. In fact, let me just compress this a bit so I can get a better idea of where we are, and just drag this over. So the market opens here. Let's just have a quick calculation, see where we are already on the downside. Doesn't look a lot on the daily chart, and compared to the past, where you'd be lucky if you got a 50-point move on the overnight. Now we're 460 down, as you can see here. 460 already down. And say, going forward, it's not going to get good with earnings, economic data, and all the rest of it. It's going to get ugly, to say the least. So yesterday the market moved lower in the pre-market, in the main event, 230. You can see prices moving lower, and then they managed to move higher. Then we've got more or less a double top as opposed to a 76% retracement there. But we'll just have a quick look. From this high down to the 20-bar moving average, you can see there price is trading up to 76%, but as soon as they close below the 20-bar moving average, they attempt to come back a couple of times, and then down we go, and then a retracement back through, and then overnight we're seeing the market moving lower. As the market started to close, the prices continued to fall there. Any other economic news out today? We've got the ADP non-farm employment change. Actually, in fact, isn't Friday, the non-farm payroll figures? Let me just have a quick look. Okay, so let's have a quick look, see what we've got. So we've got the ADP non-farm change today. That's forecast at minus 150. And then tomorrow we've got the unemployment claims as well. You can see last week's 3.2 million, and tomorrow they're forecasting 3.5 million. I wouldn't be at all surprised if we don't see this continue at this rate going forward with the lockdown. And then on Friday we've got the unemployment figures again. So it's a big week for unemployment numbers here. Forecast is for minus 100. I don't know why, but 273 was the previous. It's going to be anywhere near that. We'll see how this comes out when they are released. On the implied volatility front, interesting here as well, because we're back below the 20-bar moving average, which we'll see in more detail in a moment. In the implied volatility, 56.19, the low of 21.86, and it's the 50% retracement on this is 53, and if it doesn't break the 50% retracement, then you get another leg down in the prices, is what I found since 1994, keeping this sort of analysis and record. So the fact that the implied volatility hasn't broken the 53% area, again, also backs up another leg to the downside, and again combined with the bad news that's going to be coming. Here's the visual view of this. As we say, we're not broken or closed above the 20-bar moving average in Dow prices, and we're now back below the 20-bar moving average in the implied. However, I would expect this to soon pick up and move back to the upside, as you see here, where you've got moves below, and then you go back to red there as well. This one just stayed red and came back, and this one too, but this is exceptional circumstances here. I would expect this to do this and move to the upside. A couple of other things before I finish. Interesting here, letter from the Bank of England, and again, something that you will not see anywhere else. If I can find it, I'm just going to scroll through here. Very interesting things here, taken by the let me backtrack. In 2000, after the 2008 crisis, there were measures put in place to stress test banks, make sure they had enough in reserves to make sure that we didn't go through what we went through in 2008 with regard to bailing the banks out ever again. However, now we're in another crisis. This is very, very interesting, because it states here, a number of decisions taken by the regulators will ensure the financial system has the capacity to ensure the uninterrupted supply of credit to the firms and households that need it. These include a reduction in the counter-cyclical capital buffer to zero, which means basically we're getting rid of all of the stress testing now, and the banks can do whatever they want. They can have zero reserves. It's no longer necessary. So as you continue to read on this, these include the reduction to counter-cyclical capital buffer to 0%, supervisory guidance reminding firms to make use of their capital and liquidity buffers as necessary, the Bank of England's statement on provisioning under the relevant accounting standards, and the decision to cancel the 2020 stress test to amend the timetable for the biennial exploratory scenario. The Bank of England and the FCA have also identified a number of other prudential and conduct measures that will be adapted or delayed in order to alleviate operational burdens on firms. Fascinating, isn't it? So what's happening in the US? Well, oddly enough, reserve requirements in this message they put out on the 15th of March. Federal Reserve actions to support the flow of credit to households and business. Now, this was out on the 15th of March, but what is interesting, if we go down into this bit here, they actually did this in January 2019, announced its intention to implement monetary policy in an ample reserves regime. Reserve requirements do not play a significant role in the operating framework. So in light of the shift to an ample reserves regime, the board has reduced reserve requirements ratios to 0% effective from the 26th of March, the beginning of the next reserves maintenance period. This action eliminates reserve requirements for thousands of depository institutions, that means banks, and will help support lending to households and business. So here we go. We're throwing, this is called the kitchen sink approach to finance. The banks now, high street banks, and whatever the stress tests are now cancelled forthwith, and we're going to allow them to, or the central banks are going to allow the banks to have no reserves, and they are to lend this money out and whatever to try and keep the economy going. Very difficult to borrow money when you don't have a job, of course, and or you're on a very tight budget as it is, and an uncertain future, given the devastating unemployment figures last week and what we will probably see tomorrow as well. So I'll just leave that one with you. It's when you have a trawl around the internet, you pick up these snippets of what's really going on behind the scenes and what they're doing with your financial future. Anyway, I'll leave you with that, and let's see how the Dow fares today. I would expect, as I say, for me, the rally, the dead cat bounce, looks at this point to be over. They've thrown everything as far as liquidity to the market at the moment with the 2.2 trillion. That settled the markets, but the problem is it's not going to be enough. It will never be enough. And it's going to take another leg down to shake out this market before it turns around and moves back. Could it go back to the all-time highs? You bet it can. They will do whatever they can to get this market back. Even if the underlying economy is dying, they will do whatever they can to bring the assets back for the 1% who always seem to benefit from such moves. And that is it for this one. As ever, thanks for watching. See you in the next one.